Hello, this is George, and I'm introducing the fifth installment into my Easing into EasyLanguage series. Like my other books, this book is designed to teach you EasyLanguage, or at least extend your knowledge of EasyLanguage. I wrote this book for two reasons, because I really didn't think I would add any more books to the series after the day trading edition, but I wanted to add this book because some of the EasyLanguage that goes into programming these systems can be rather complicated, because what we do in this book is we discuss all the different algorithms. I think I discussed 10 or 11. And I discuss fixed fractional allocation, position sizing, and I also discuss trade filtering and also money management. And also I go into detail a little bit about some of John Eller's smoothing functions. And of course, I discussed the turtle trading technique, and especially the idea of only taking a trade after a losing trade, and how do you program something like that. And the other reason, if I didn't say two reasons, the other reason is I wanted to discuss the trading legends that became, that these men became famous back in the 80s and the 90s and early 2000s, because their algorithms were quite successful. And a lot of the foundation of these strategies were the foundation, I should say. A lot of the ideas in these strategies were the foundation for the research that a lot of CTAs in the 2000s and in the teens utilized in their trading plans as well. And I don't want these legends to be forgotten. And like I said, they were very popular. A lot of money was managed on the algorithms that I'm going to discuss. I'm not going to give the exact algorithms out, but I'm going to give you the essence of those algorithms. And so it's important that I want to keep the memory of these men alive, because they were very popular. And I think you can learn how to program. That's my number one objective, is to teach you EasyLanguage. Now, I'm going to give you complete trading systems, but I don't want anybody to take these trading systems and think you can just apply it to the markets and start trading, because these systems, they were popular, they were successful, but they all had their pitfalls, and they had drawdown. And a lot of times the drawdown was so immense that people had to stop trading these systems. So, like I said, this is a educational book, and it's an educational video as well. So let's jump over here real quick. Back in 1997, and I think I probably did it before then as well. I probably did it in 95. But I published for Futures magazine, I picked the top 10 systems of all time. And these were mostly trend following systems. Not all of them, but most of them were. And then it was updated in 2001 in an article called Top 10 Systems Tackle a New Millennium. And I'm going to be discussing some of these systems. Let's see if I can get this into your view. I'm going to discuss aberration-like systems. I'm going to be discussing some of Randy Stuckey's work, like CAT scan. Also, I'm going to give you dynamic breakout, which was mine. I designed that system back in 96. And there is other systems that are similar to these that I discuss, maybe a little bit newer. A couple of systems were post 2001, but this article was written in Futures Magazine, June 2001. They were very popular systems, and you can tell by the equity curve. The systems were very successful from 86 to 2000. It's a beautiful equity curve. And of course, that all changed, as we know. If you don't know, it did change. So this video is the first in the series of video that goes along with this book. And this is where I'm going to discuss some programming techniques. I'm going to try to go through each one of the techniques that are in the book. And I'll start with one at the end of this video. And I'm going to try to keep these videos short, to less than 10 minutes or so. But I think this is an interesting discussion about robust trend following systems that were popular, fell out of popularity, and I think we may be primed for another period of time where trend following works. I know during the 2020 pandemic, the genesis of the pandemic, the prices of the commodities went haywire. Crude inverted and went negative. The futures did, and a lot of the other markets started, moving, and that's what we had missed for many years, was market movement or trends. And we may see some trends developing. We saw some trends developing in 2020 and 2021. We've been in some whipsaw lately. But again, if you want to add to your programming skills and your programming knowledge, this is a good book to pick up. And I should have this published probably beginning of October, maybe sooner. I have basically written the book. I'm just going back and proofing it right now. So look out. I'll send an email. And always check Amazon.com. When you buy the book, you get all this code. Of course, it's all disclosed. I'll create workspaces for you. I've got some Portfolio Maestro stuff in there that you can utilize to help you do that type of stuff. Here's the workspace you get, and if you pick on, let's just choose crude oil. I like using crude oil because trend following systems seem to work well in crude oil. If a trend following system doesn't work in crude oil, there's a good chance it won't work in any market. I mean, crude's a really good litmus test to see if the trend following system is going to work. Now, that doesn't necessarily mean it won't work in other markets. It's just something I like to jump on first. I just use crude oil. And so we've got a crude oil chart somewhere in here. Let me see if I can locate it. Where's crude oil at? There it is right there. And I'm going to go ahead and blow this up. Boom. I'm going to show you what's in here. In each chart, you've got this. I preload each chart, so you get this. It is strategies. You get all the systems I discuss. I discuss aberration strategy. It's aberration-like. The aberration original. It's not really the original, it's aberration-like. Most of this is Keith Fitchen, most of his systems are discussed at length in his book. You just have to piece it together. I've got Peter Waite's Andromeda-like. And again, I'm not going to disclose exact systems unless they are in the public domain. If it's not in the public domain, I will discuss the essence of the trading system and the essence of the developer who created the trading system. I'm going to discuss Randy Stuckey's CAT-SCAN-like. Clinal's in a book, so I can fully disclose that. Parabolic as well as Wilder, I'll discuss that in detail. Again, Peter Waite, Pegasus-like. Simple Harmony-like and Super Turtle-like. These are both from Murray Ruggiero. I partnered with Murray on several projects up until he passed away. Rest in peace, Murray. He's a great friend of mine. I still miss him tremendously. Here's some more to Clinal stuff. It's Andreas Clinal in his book. And I also discuss Michael Cavell's book, the 2005 book, the Trend Following book. He gave a system in there. And there's a system on here that's not listed. It's by Bruce Babcock, which was published in 1989. It's the second oldest strategy that I'll discuss. It's the second oldest. The Parabolic was published by Wells Wilder in 1978. The concept is still, relevant today. So I thought I'd discuss that as well. Okay, so we're going to go ahead and do the aberration original. This is Keith's original approach, and like I said, it's basically disclosed in his book. I pieced it together for you. Of course, I was privy to all this information here, but again, I'm not going to disclose information that might be considered proprietary. So let's go ahead and let's take a look at this. Let's go ahead and make sure that's active. Let's turn that one on. Let's turn this one off. That's the top one. This one is here. I'm going to go ahead and do properties for all. I'm going to turn it on. This video might go over 10 minutes. I apologize, but it is the introduction video. So I'm going to try to keep this one down at 15. So we're going to go ahead and hit that, turn that one on. And as you can tell right here, this is the choppy market. This system does not like. The market is chopping here. I mean, it's wide ranges. I mean, we're going from what, $90. The high was 88. The low down here was 61. That's what, $27. But it really hasn't. This is a nice trend. It should have caught that, you would think. But there is a trend that aberration-like systems like, or it can take advantage of, and this isn't the type of trend it can take advantage of. Let's see how much data we got back. We got here. Sorry about that. That was edit data. Let's see how much data we're looking at here. I'm looking at crude oil. I'm going back 15 years. Let's go ahead and pop that back to. We can go back to 2006 or so. So what is that? 18 years. Let's go ahead and add 20 on here. Let's view the custom report. The performance report. I don't know if I said custom, but the performance numbers. Here's a performance graph. There's your '08 move when crude went skyrocketing. In today's terms, it would be that was $150 a barrel, I believe, at that time. And if you translate that to today's numbers, it's really up there. Of course, after '08, it fell apart. 14 had that rally back, and after 14 is what I call the desert of desolation. And I go into detail what I mean by the desert of desolation. That's the time period inclusive of 2015 all the way to the beginning of the pandemic. So here's the beginning of the pandemic. You have this nice rise, and since we had those nice moves in 20 and 21, 22 has not been too good to this system. Now you're saying, well, George, the equity curve doesn't look too great for a 20-year time period. I mean, it made all of its money in what, 2008, and you're probably, you're actually 100% accurate with that observation. But who knows what the future holds? And also, you don't see what happened before 2006. And with TradeStation, it's hard to get good data going back, because if you look at the data going back that far, sorry about that. I thought I had grabbed the cursor or the whatever that scroll thumb is. The data, if you look at this data, you say, wait a minute, that doesn't look like good data. I mean, look at these gaps here. I mean, we gapped, what is that, 124.30 all the way down to 120.91. That's almost a $4 gap overnight. Well, that gap didn't exist. What you're looking at here, when you go back really a long time using TradeStation data, and in a lot of cases other data, you're looking at the electronic data only. This is the electronic pit data, or non-pit data. And at this time period, the pits were still popular. So the pits were still being traded at this time. So to get that data, good data, you have to buy that data. And I buy my data, my end of day data, from Pinnacle Data. You can buy CSI data, and you can import this directly right into TradeStation. It doesn't require a lot of work. Once you get it set up, all the work is, once you get the work done to get it set up, it's all done for you. You're complete. And using the data is very easy after that. So let's go ahead and let's go back in time. Let's go ahead and change this data. I'm going to look at some Pinnacle data going back a little further. So I got to go to Edit Symbol. And like I said, the beauty of TradeStation is you can put in any data you want if you put it in the right format. So I'm going to go down to ZU, okay, ZU Rev. And in Pinnacle data, ZU is the symbol for crude, but it's the symbol that combines the pit session with the electronic data. So there's a smooth transition. So when you're testing it, you don't see that, you don't have a period of time where it's not good data. And the REV stands for reverse adjusted, meaning the most recent data is accurate and it back adjusts using Panama adjustments at the rollover. So you don't have to worry about the rollovers as well. So let's do ZU Rev. Let's go back 40 years. 40 years? Yeah, you can go back 40 years. If you've got the data, you can go back that far. There we go. And you're saying, okay, does the data look good in 07 or so? So let's see what 07 looks like. I don't like how small this little thumb thing is. What is that? That's 06. See, there's your data, '06. Looks like good data. And we did have the overnight gaps because there was no overnight trading at this time, like there is today. Your crude oil will open at 6 o'clock Eastern, I think. Is that right? Yeah, and close at 5 o'clock Eastern. And so you have 23 hours of trading nowadays, and you just have to wait. And they use the 6 o'clock opening as the official opening, and the 5 o'clock that's not the close. That's the last tick. The close is the settlement price, which is a fictional price that is kind of decided, and it's usually around the 4 o'clock or 3, whatever the original pit session time close was. It's around that time period that you get that settlement price. That's the reason you will not see me executing on the close, because there's no way you can get that price. Okay. And that says Quandl crude. I don't know why that says Quandl crude. I think maybe I used a Quandl. I used to use a lot of Quandl data when you could get the data, and I probably just used the name Quandl. But this is Pinnacle data, and you can just go to pinnacledata.com and look that up and get the prices for that. So let's go back. Let's look at the equity curve real quick. There you go. So you got this nice move that was very, this was a lot of trend following systems in crude oil back then. Hardly any deviation. Then you had a huge rally in '08, and then you had the give back during the desert desolation starts here. This is the desert of desolation here. New highs just recently, and then we've given quite a bit back, the last couple, 3-4 months. Okay, the code for this, because I'm going over my time limit again, like I usually do. The code for this strategy, here's the aberration-like strategy, found in Keith's book, Building Reliable Trading Systems. If you can get your hands on this book, I would suggest purchasing it. If you can get your hands on it. It's a difficult book to get. They're asking a lot of money at places, but I still think you can find you a reasonably priced copy. And in this book, he talks about various trade entries, and of course, the one that he discusses quite often is the standard deviation or the Bollinger Band approach. And this system is a Bollinger Band breakout. Okay, many people use the Bollinger Bands because it, with 2 standard deviations, it'll encompass 95% of the market movement within the bands. So Keith figured out that if it broke out as an aberration trade, right, you're outside the 2 standard deviations, that must mean you've got some momentum, and that might be the genesis of a long-term trend. So that's how he developed this trading system, which makes perfect sense. Keith Fitchen was a very, very intelligent individual. I met in '93 at a trade show in Chicago. He invented this system in '86, released it to the public in '93, and I worked with him on several projects. He and Murray worked together closely as well. So this was basically his idea of a trend following approach. And he was very proud of it because he applied it to a bunch of different markets, and it was very successful across different sectors of markets. It worked in the crude, energies, the grains, the softs, the interest rates. It seemed to work in almost every sector, and it basically only had this one parameter. And he used 80 or 60 or 50 or whatever, and he always used 2 standard deviations. Okay, so those are market-derived values. I mean, you're using the volatility of the underlying market, be it a soybean or be it the crude, to tell you what the levels where you should be buying or selling at. It's not like you're saying, I want to buy $2,500 above the prior day's close. Okay, that's not a market-derived parameter. It's $2,500 is a hard number, and it's not relative to anything. $2,500 in the ES is different than $2,500 in soybeans. So Keith was very proud that this was basically only one parameter. You could say it was 2, counting the 2 standard deviations, and he could have optimized this number, this 80 and this 2, across all the different markets, and come up with different parameters for each market. And of course, he saw that as over curve fitting, and I would all have to agree with him. I think that is over curve fitting. Now, could you have different parameters on different sectors? Would that be over curve fitting? For example, in, I don't know, the interest rates, bonds, the T-notes, 5-year, 2-year, whatever. What if your Bollinger Band was 60 and your number of standard deviations was 1.5. In crude, say it was 70 and 1.75. Would that be over curve fitting? That's up to you to make that decision. As long as it's not on a per market basis. So if say euro currency is 80 and 2, and Canadian dollar is 65 and 1.25, and Japanese yen is 32 and number of standard deviation is 1.78. Now you really are curve fitting at that point. So if you keep your optimizations at the sector level, it's still curve fitting, but it's not as bad as doing it at the market level. Okay, so this system is very simple, and like I said, this is introduction. All the other strategies in this book, I wouldn't say all of them, but more or less 90% of them will be more complicated than this, especially when we get into money management and trade filtering, and of course the turtle technique of skipping the last trade if it was a winner. Okay, you only take a trade if its last trade was a loser. So you determine the buy level, and this is just the format I like to. This is my programming style. If you've read my books, you know my programming style. I like to put the inputs and vars together. If it's a long listing and I got a var way down at the bottom, and you're saying, what is that value? What is that? You have to go all the way back to the top to find out what it is. I'll usually put that variable definition closer to where I'm utilizing it, just to keep you from having to scroll back and forth so often. Okay, so when you do inputs, it helps because inputs is the interface between the user and the strategy on the chart. So you could just wouldn't have to use inputs. You could just hard code these as variables like these are, but then the user wouldn't be able to interface and change those inputs from 80 to 60 to 50, the number of standard deviations from 2 to 1.75, and you couldn't optimize if you wanted to. If you want to play around, play some mind games and optimize these parameters, you wouldn't be able to unless you define these as inputs. So I did that. And you could also add a fixed money management stop if you want to. And I'll show you how to do that in one of the videos. And it's very simple, as you would probably guess. So I have to, my inputs are here. I have to define my variables. Remember, variables are only, it's named memory. So you have to tell the computer, I need a memory location, and I want to call it buy level because I'm going to store some information in there. So you have the buy level, the short level, the long exit, and the short exit. The buy level is basically the upper Bollinger Band, okay? And this Bollinger Band, as you can tell, is green, and that's a built-in function, okay? We have indicators, we have functions, we have strategies. The indicators are the extrapolation of the functions in a visual form. The strategies use the functions to help determine trade entry. So here we're trying to determine the buy level, the short level. We're using the number of standard deviations, which was a user input here. And to get the lower Bollinger Band, which is the short level, you have to use the negative of that. Now, could I have said buy num stand devs to sell short num stand devs? Yes, you could do that. And then you could optimize different deviations off of the moving average, the 80-day moving average for long trades and short trades, or short trades, and short trades. But are you optimizing that? Now I have to say you're really curve fitting if you're changing parameters based on a long trade versus short trade, even though the market moves differently going up than it does down. So you would have something, you have some validity saying that, hey, I want to use a different parameter for my long entries and my short entries. Because nobody would argue that markets move differently going up than they do coming down. Okay, I just think you're just fitting the data too much. But of course, that's your decision. You can do whatever you want. And learning how to program these type of systems and knowing how to manipulate the inputs and how to put those in the code, that's the whole purpose of this book. Okay, this book is not to teach you algorithm development. It's to teach you programming of these algorithms so you can develop your own algorithms in the future. Okay, what is the long exit? Long exit is simply the moving average. So the Bollinger Band function only returns the upper band or lower band based on the number of standard deviations, positive or negative. The long exit is just the moving average of the Bollinger Lin, which is in this case is going to be 80. My short exit is the same as long exit. I could have saved that. I could have just said exit right here. and not use short exit, because short exit and long exit are exactly the same. But when it comes to reading, having someone else read this, or having yourself read this 6 months later, it's nice to be able to say, okay, I know what the short exit is. Exit, what is that exit? So by being very elaborate with your variable names, it helps readability for yourself and others. And of course, I use the Camelback type syntax. The first letter of all variables is lowercase. If it's a multi-word variable, like by level, I'll put the second word is a capital L. If it's say a 3-word variable, I'll put the second is S, which is capital S. Standard devs, so there's D, capital D. It's my style. I also like to follow a very strict when tabbing, indentation. If you ever program in Python, indentation is so important. It'll teach you indentation because it will not work without indentation. You don't have to do indentation here. You could just say that right there if you wanted to, which makes perfect sense. I have no problem with that style there, but I like to do it like this because I know that this line of code is controlled by this if-then construct. Okay, so everything controlled by the if-then construct is indented, either by a tab or 4 spaces or 5 spaces, whatever you like. That's up to you. I usually use a tab in EasyLanguage. 4 spaces, of course, you have to use in Python. Of course, this is Power Language compatible as well. EasyLanguage, Power Language, basically the same thing. 95% is the same. So if you're in multi-charts, you can utilize this code as well. And I've made this really compatible with multi-charts. And I used multi-charts Portfolio Trader to create a lot of the reports that you'll see in the book. Okay, if I want to say, okay, if I penetrate the upper band, I want to buy, I give it a good name. Here's my signal name. You don't have to have that. But again, anything that makes it easier for another person to read this or yourself to read this 6 months down the road, or when you're going through the trades and say you have multiple entries, say you have like 2 or 3 buy entries, and you need to know which one got you long, naming your signals helps with your analysis down the road. Okay, so just get used to doing that, and if you get used to doing it, it's second nature. If the close is below the short level, I have a penetration below the lower Bollinger Band. I'm going to sell short, and I'm doing next bar at open. You could say buy this bar on close. I will not do that in this book. Again, you can do it theoretically, and you may want to play around with it from a theoretical perspective, but you cannot capture that close price. It's impossible. Again, it's a fictitious price. It is within the range of the closing range and also the range of the day. But again, getting that price, I don't know. You won't be able to do it. And in the long run, would it wash out? It probably would. I mean, you'd get positive slippage and negative slippage. But buying the next bar to open, you can do a market order right at the open. So this is something that's non-theoretical. You can actually do it, and you will be slipped. You will have positive slippage and negative slippage. And from my experience of years of trading, doing these market orders on the open will wash out. You'll get positive slippage and you'll get negative slippage, especially if you're buying and selling short. Okay, if I'm already long, market position equals 1. Means I'm long, and it closes less than long exit, the moving average. Then I'm going to sell long exit next bar to open, and the same thing goes for the short side. If I'm short and the close is above the short exit, then I'm about to cover short exit next bar to open. Okay, this was a very simple system, and this is just a teaser for the book. The book is I think it's almost 200 pages in length. I'm going to have videos in here just like this one, but the other videos won't be in the introduction. I'll be discussing the trading strategies. And like I said, they do get relatively complicated. Let me open one real quick. Let's look at the Babcock version. That thing is very, very complicated. It's a multi-step approach to trying to determine trade entry. Let's see if I can get down here. Where are you at? There it is. Let's open this up. here's the Babcock strategy. So it does get a little bit hairier. So, but not much. I shouldn't have picked this one because I did distill this. This is like 3 pages in a book, and I distilled it down to this little bit of code here. So maybe that's not the best example to show you with complicated code. But it was very complicated definition of the strategy, but I was able to distill it pretty good. Okay, I went way over my time, but this is like I said, this is the introduction video. My other videos will be much shorter, and I will discuss at least 10 trend following strategies using different entry and exit techniques, money management, and things like that. So I look forward to talking to you in the next video, and I hope you enjoyed this video. And buy the book because, like I said, you can learn a lot by example, and that's what I'm teaching here. I'm not going to have the tutorials like I did in the first 3 books or first 2 books. Yeah, first 2 books I had tutorials which were very simple. We're going to discuss complete trading algorithms here and how I was able to accomplish what the vendor intended their trading systems to do. Okay, thank you.